Bitcoin just dropped below $68,000. And what most people don't realize is that this move just activated a technical pattern that hasn't triggered since 2022. The last time this happened, Bitcoin crashed another 40% in weeks. But here's the thing nobody's talking about yet. There's still a window to understand what's actually happening right now. Look, we've been in a bull run narrative for months. Everyone's talking about spot ETFs, institutional adoption, the halving. And sure, those fundamentals exist. But technicals don't care about narratives. They care about where the money actually is. Right now, we're seeing something shift. Bitcoin broke through support levels that were supposed to hold. Volume patterns changed, and the macroeconomic backdrop just got weird again. This matters because we're at an inflection point, not a crash guarantee, an inflection point. The difference is critical. At inflection points, the next move determines everything for the next several months. Get it wrong, and you're chasing losses. Understand it, and you can actually position accordingly. So let's get into the actual mechanics. Bitcoin's been consolidating between roughly 62 and 73,000 for a while now. That range gave traders false confidence. But consolidation doesn't mean stability. It means pressure building. When I look at the chart, we broke below the 50-day moving average. Then we lost the 200-day MA support. These aren't random lines. Institutions use these exact levels. When price breaks them on high volume, it signals that smart money is rotating out. Here's the pattern that matters. In 2022, we saw this exact sequence. Minor support break, then a false recovery, then capitulation. The 60,000 level isn't arbitrary either. It's a psychological barrier and a major support zone from the previous cycle. If we lose that, and this is the critical part, the next technical support doesn't appear until the mid-50s. That's a drop from current prices that would terrify most retail holders. The reason this is happening now? Several things converging. Federal Reserve signals are getting hawkish again. Inflation data surprised to the upside. The bond market is pricing in higher for longer interest rates. When that happens, risk assets like Bitcoin get repriced. It's not about crypto specifically. It's about what happens to all speculative assets in a higher rate environment. But there's another layer. On-chain data shows whale accumulation patterns weakening. Funding rates on leverage trading are still elevated, which means positions are over-leveraged. When you have over-leveraged positions combined with technical breaks, you get forced liquidations. Forced liquidations create cascades. Price falls triggers more stops, more liquidations, more selling. So what does this mean for you? First, this is why position sizing matters more than being right or wrong. Second, stops and take-profit targets aren't boring. They're survival tools. Third, and this is crucial, crashes under extreme conditions can actually be opportunities if you're prepared psychologically. The risk scenario is real. A break below 60,000 would be serious. But it's also happened before. Every major market crash is followed by either capitulation or recovery. The traders who did well weren't the ones predicting the future perfectly. They were the ones with plans for multiple scenarios. If you want to understand these patterns before they happen instead of after, subscribe to Crypto Genius. We break down technical setups, on-chain metrics, and macroeconomic signals weekly. This is the kind of analysis that separates reactive traders from prepared ones. Subscribe now.